$619 billion. Gone in 72 hours. September 15, 2008, 1:45 a.m. Lehman Brothers files. Chapter 11, 25,000 employees. 158 years of history. And the trick that hid the bodies was perfectly legal. To understand how a 158-year-old bank dies in a weekend, rewind 6 months. Lehman was founded in 1850 by Henry Lehman, a German immigrant in Montgomery, Alabama. A dry goods store that took cotton as payment. By 2007, it was the 4th largest investment bank in America. 25,000 employees. 40 countries. Then came March 14, 2008. Bear Stearns collapsed over a weekend and was sold to JP Morgan for $2 a share. Backstopped by $29 billion from the Fed. Every trader on Wall Street asked the same question. Who is next? Repo 105. Here is the trick. A repurchase agreement, a repo, is the plumbing of Wall Street. A bank borrows cash overnight from a money market fund. Posts bonds as collateral, the next day pays back the cash plus interest, gets the bonds back. Standard. On the balance sheet, it is correctly recorded as a short-term loan. But Lehman's accountants found a sentence buried in Accounting Standard FAS 140. If the collateral you post is worth more than 105% of the cash you borrow, you can call the transaction a true sale, not a loan, a sale. The bonds leave your balance sheet entirely. The cash comes in. Lehman uses that cash to pay down other debt. Then a week later, quietly, after the quarter has been reported to the public, Lehman buys the bonds back. They named it Repo 105, after the 105% threshold. Here is the kicker. No American law firm would sign the legal opinion, not one. So Lehman flew the contracts to London and got Linklaters, a magic circle firm, to sign under English law. Pure opinion shopping, an American bank, lying to American regulators, using an English legal opinion. To make American debt disappear every 90 days. Why did it matter? Because Wall Street rewards balance sheets that look clean. Investment banks live and die by one ratio. Leverage. How many dollars of assets do you carry for every dollar of equity? Ratings agencies watch it. Bond investors watch it. Counterparties watch it. According to the bankruptcy examiner Anton Valukas of Jenner and Block, who filed a 2,200-page report in March 2010, Lehman used Repo 105 to vanish $49.1 billion at the end of the first quarter of 2008, $50.4 billion at the end of the second quarter, roughly $43 billion at the end of the third, always at quarter end, never any other day of the year. The reported net leverage ratio in Q2 was approximately 25-1. The actual leverage, with Repo 105 reversed, was approximately 31-1. Roughly 30% understated. Investors looked at 25-1 and saw a stressed but functioning bank. 31-1 would have triggered a ratings downgrade. Margin calls, counterparty flight, months earlier. $50 billion, every 90 days, evaporated from public view. The bank looked 30% safer than it was. Until the morning the trick ran out. September 13, 2008, a Saturday. Treasury Secretary Hank Paulson convenes the heads of every major Wall Street bank at the New York Federal Reserve Building on Liberty Street. Lehman's stock closed Friday at $3.65. 2 possible buyers in the room: Bank of America and Barclays of London. Bank of America walks. They want Merrill Lynch instead, a deal announced the same weekend. Barclays is willing, but the UK Financial Services Authority refuses to waive a shareholder vote requirement without a US government guarantee of Lehman's trading book. Paulson refuses. He is not bailing out another investment bank, not after Bear Stearns. The lights stay on at 33 Liberty all Sunday. By Sunday evening, the deal is dead. At 1:45 a.m. on Monday, September 15th, Lehman Brothers Holdings Incorporated files Chapter 11 in the Southern District of New York. $619 billion in assets. 25,000 employees logging in to find their keycards deactivated. The Dow opens 500 points down. The next day, the Reserve Primary Money Market Fund breaks the buck, the first time in 14 years. One weekend, 2 declined bidders, 1 refused bailout, and the largest bankruptcy in American history. What did Lehman's collapse change? October 3, 2008, Congress passes the Troubled Asset Relief Program. $700 billion, explicitly authorized to prevent the next Lehman. July 21, 2010, Dodd-Frank becomes law. The Volcker rule embedded inside it bans most proprietary trading at federally insured banks. And the people? Richard Fuld, the CEO who collected approximately $484 million in compensation between 2000 and 2007, was never criminally charged. The SEC closed its investigation in 2012. No fraud case brought. Linklaters faced no sanction. The accounting loophole that hid $50 billion a quarter was not illegal, it was one sentence, in FAS 140. And the man who built the firm that exploited it walked away a multimillionaire. Next on Forensic Files and Fortunes, WorldCom. 2002, the telecom giant that reclassified $11 billion in operating expenses overnight as capital investments. The internal auditor named Cynthia Cooper, who uncovered it on a single spreadsheet at 3 in the morning. The CEO who borrowed $400 million from his own company. The largest bankruptcy in American history, until Lehman beat it 6 years later. Subscribe. Every week we open the books on a corporate disaster.